All right. Good afternoon, everyone. Live stream Tuesday with me, Paul. And yeah, today I'm going to show you a stock that, I think that, well, I mean, I full disclosure, among other disclosures, I own the stock and quite a lot of it and have owned it for a long time. Went for a rocket ride in 2021, crashed back, but I've not sold it. And recently I found out about something that made me think like, yeah, I mean, makes me feel like that much more confident in it. And then they reported their earnings and then they released something else was like, oh, damn, this is definitely going to happen. So I want to share the stock. I want to share the information. And this is a genuine penny stock. Yeah. I mean, it's like a dollar. Now, okay, it's about $2, something like in that range. And they've been around for a while, and I've known this company for a long time. But I'll tell you the story in a bit. All right. Okay. First, let's do all the usual things. Legal disclaimer and disclosure, which is that this live stream and the content from ATG Digital Media is not investment or financial advice. It's presented as opinion, information, engagement, and entertainment. All ATG digital content may contain errors, oversights, or mistakes. Understand that investment operations, which is what, like buying or selling a stock, options, crypto, have significant risk and can lead to the loss of your principal. Bottom line, you could lose money. The owners, employees, contractors, own, trade, transact the securities I mentioned in this video. I definitely mentioned, like, I own the stock that I'm going to tell you about, and all content from ATG Digital Media. We do not take money from companies or crypto people, promoters, sponsors, whatever you want to call them, to recommend their stocks or crypto tokens. For better, for worse, for profit, or for loss, everything that you get from us is based on our own independent judgment. Quick plug for all the various free stuff that we put up, this daily Substack. Actually, last week put up 2 Ball Man Speculating podcasts. So those of you who like the Ball Man Speculating podcast, check into that. And obviously, I'm on YouTube right now. Very active on X/Twitter, Instagram. Yeah, I've got to stick more selfies and just put those up there because I'm not quite sure, how to use Instagram for investment purposes. I'm sure there's some way. Facebook, I do a monthly Facebook Live, and Dean is quite active on keeping people engaged and entertained. All right, let's start with. So I was a fairly young-ish analyst in 2002, and this was a bear market. That was a brutal bear market. It's 22 years ago, so nobody would remember, but I mean, the thing about bear markets is that it's just hard to find stocks that are going up. So there was this stock, and there were a lot of companies that came IPO, like sort of in like the post crash period between like 2001 and 2002. There were a lot of like medical device companies. There were some biotech companies. And so we found this company, and we like our team, we found this company, and we're like, what do they even do? And so like we researched this, and when we found that like much bigger device companies and stents are like these like tubes that go into your arteries and stuff like that. The companies that like were making stents, which were very hot back then, very hot, big growth sector back then, because they were fairly new, were like, hey, you should check into this company because they can like do something like magic. When we're like, well, what can they do? And they're like, they've got magnets that can move these catheters in the body. And we're like, really? And we're like, well, why would you need something like that? They're like, well, when a surgeon has to put a catheter, I mean, you got to like cut like an incision. I think it's done actually through your thigh, and then like it's snaked up all the way up in through there, or maybe it's your stomach. But if I remember correctly, it's actually like your thigh. And I was like, I have to admit, I'm a bit queasy about blood and stuff like that, even though like I'm very into researching medical and biotech stuff. And so we were very intrigued. And so we looked into the company more, and, we saw our demonstration. You're like, wow, next world company. Like, damn, you know. So we went and pitched, the portfolio manager, like, this company, it can do good. The stent company said this could do well, because like it takes away one of the problems, because as good as any surgeon is, I believe they call it electrophysiologists are, it's pretty cumbersome to actually like do one of these procedures in the heart, because you got to see into the heart, for which you need like an X-ray machine, right? I mean, so now you're talking about radiation. So the folks that do this, they have to wear like this like very heavy like iron vest to protect them from radiation. And then they are like, like be good enough to under all this like duress, right? I mean, to also like handle this very delicate like movement of the catheter. I mean, you're talking about the heart here, right? Very, very, very delicate, right? So it seemed like a no-brainer. Like, come on, I mean, this technology will take off. Yeah, it didn't take off. It didn't take off, and the company struggled for a while. And I'll show you a stock chart. When I say it didn't take off, I mean, like, essentially the thing collapsed. I mean, things just utterly collapsed. And but still, like the basic benefit that this company provided. In other words, you could sit at a terminal, and then using like a mouse, you could actually like take this catheter into the heart with a level of precision and care that, yeah, I mean, I love like, what human beings can do, but here, we can take it above a certain point. I was like, this thing's got, got to have some like, long-term benefits. So at some point, like, I kept tracking it, and it got down to like 50 cents. And I was like, okay, I'm going to buy some. And then I bought some more. And that, of course, got me interested. And then once I left Banyan Hill, and that like their ridiculous policy where you couldn't recommend things that you own ended, I put this into the portfolio. It hasn't done incredibly well, but I think this is the time. This is the moment. All right. And I'm going to show you why. And there's like two big things that I actually recently found out that make it even more intriguing. So I didn't know this, but in 2021, the compensation committee, like every company has like a committee that determines what the compensation of the management is going to be. So all of you, well, hopefully all of you know about, the whole Elon Tesla saga about his compensation, right? I mean, essentially he's like, I will be paid nothing. I think it was $1. And then if I hit these certain targets, then I get, essentially it was like, I think like 6% of the company, 8%, 10% of the company, something like that. Essentially turned out to be like this, I think it's 400 billion, 500 billion. Now, I mean, the targets were crazy, and the targets were also a little bit unusual. They had to do with the actual like stock price, right? Which, I mean, as shareholders, we'll like that, right? Like, yeah, I mean, we want you to do things so that it moves the thing that matters to us, right? Which is the stock price. I mean, if the business does well and the stock price doesn't do well, yeah, I mean, it's kind of great, but like as a passive stockholder, like it's not like you can be like, oh, you've got all this money here, or you've got this building. Can I have a piece of the building? You can't get a piece of like all of those assets. So without the stock price moving, you don't get anything. So incenting the managements of companies to be like, okay, make it so that whatever is done moves the stock price. People think it's a bad thing. I don't think it's a bad thing. And I think as a shareholder, it's a good thing. Okay. I mean, hey, yeah, I mean, I want the stocks of the companies that, I own, that we own at ATG Digital. I want them to go up. I want them to go up. I mean, in a way where like, yeah, where the business is what drives it. because the other stuff is just pure pumps and hypes. I mean, and you can play that for a bit, but like those are not sustainable long term. I mean, and you just never know when it ends because some like, some puppeteer is like, manipulating the game, behind the screen. But when it's a business, you have some insight, you have some understanding. You can go read the annual reports, you can listen to the management, you can go research the technology, you have some understanding. And so you're like, okay, when the thing like dumps because there's some crash or some panic, you're like, okay, I'm not gonna do anything here. But when it's just a pump and a hype, you don't know. Maybe the pump's going to end. Maybe the hype is, all just, a bunch of crap, Okay. So long story short, so I find out that the CEO of this company, and we're talking about a small little company here, right? Yeah. I mean, at the peak in 2021, I think the market capitalization got to like $1 billion, which, we live in a world of multi-trillion dollar companies. Apple, 3 trillion, Microsoft, 3 trillion. Yeah. I mean, there's like 5 companies in the US stock market worth like $1 trillion. So, $1 billion is like, sounds big, but it's nothing, right? In the grand scheme of, of the stock market or assets, it's nothing. But it crashed. I mean, it crashed right back down to kind of like where it was in 2019. But in 2021, I'm guessing at the time, after the stock had mooned higher to about $10, which is where it was, the compensation committee of this company, they're like, okay, we are going to put together a pay package for you where if the market capitalization of this company gets to $5.5 billion, essentially this person gets about 10% of the company. I mean, 10%. I mean, a 5.5 billion, 10%. Yeah, I truthfully, I mean, I'm a little ashamed that having owned the stock for this long, I wasn't aware of this. I just have to say that. But I saw this on X, previously Twitter, and I was like, oh, damn. Now, obviously in 2021, from 1 to 5.5 billion seemed like, yeah, I mean, that seems not a bridge that's far. But today, I mean, the stock is 100 and $160 million, 160 million to 5.5 billion. That's a rocket ship ride. Yeah, that's a rocket ship ride, right? Yeah. In other words, for it to get to 5.5 billion, I mean, they really need to do something. I mean, and I'm not talking about like go and market the stock to, every hedge fund on the planet. I mean, they got to do something with the company. They got to do something with the technology. They got to do something to actually like earn and make this wealth, right? Yeah. So let me, unveil the name of the company, what I'm talking about. So the company is Stereotaxis, STXS. Yeah. And this is the compensation agreement. You can see it's in February of 2021, and you'll see that it's in the second paragraph. The full vesting of the award is contingent upon Stereotaxis market cap increasing to $5.5 billion. And the name of the CEO is David Fischel. And I believe David actually already owned quite a bit of the stock. So, I mean, this is an additional amount. His cash compensation is $60,000, which, I mean, in today's world where, I don't know, people make hundreds of millions of dollars is pretty modest. Even fairly small companies give their CEOs multi-million-dollar contracts, etc. So, I mean, let's just put it this way. I think Mr. Fischel is pretty motivated. I think he's extremely motivated to be like 5.5 billion. How do we get there? Well, I mean, let's look at where Stereotaxis is today, right? Okay, it's $1.88, $160 million. So let's see. I'm gonna break out my handy calculator. I think I put it in the description. It's kind of difficult to do these like numbers. 100. So 5.5 billion. I'm just going to do this number quickly. Hopefully I'll get it correct. I'm just going to round it to 160 million. So that's a 34 times increase in the market capitalization and obviously the stock price. So we're talking about 34 times, rounded out to $68. $68 is when Mr. Fischel gets to his pot of gold at $5.5 billion, $68 per share, $68 per share from $1.88 to $68. And Mr. Fischel becomes half a billionaire. I mean, but hey, I mean, if Stereotaxis can grow to $5.5 billion, why can't it go to 10 billion? Because I mean, what you need to do to get a company to jump in value, you got to do something like it's got to be big. It's got to be transformative. And if it's that transformative, it's unlikely that like the cap is like 5.5 billion. I mean, he's got a shot at becoming a billionaire, right? To me, I want to go on this ride. Maybe it works. Maybe it doesn't work. Maybe, you know, this is just, you know, a fool's errand. But hey, how many companies can you point to where the CEO and the management is this incented to not just be like, oh, we want the return on equity to be 12, 15%. Nah. This is the stock price. This is the stock price. They're like, make the stock price go up. Make the stock price go up. And you know what? Sure, there's pumps in the market, but a 35-time increase in market capitalization, a 35 times increase in the stock price ain't happening just by like a random pump. It ain't happening by people walking around on Wall Street and being like, here's my presentation deck, here's my nice little thing, like, you know, please buy our stock. It's not going to happen from that. You guys may not know, but like the CEOs of many companies, their number one job, I mean, they'll hate me for saying this, and you know, is to market the stock. I mean, I was an analyst on the buy side. The buy side means that, you know, you represent a hedge fund, you represent a mutual fund, and your job as an analyst is like you just go to these meetings one after the other. They start at like 8 o'clock in the morning, and the investment bankers from, you know, from Morgan Stanley, you know, and all these companies, they'll be like, what companies do you want to see? So these managements come in and, you know, they bring their deck and they'll talk to you. And it's marketing. I mean, that's what it is. I mean, they're marketing their stock to you. And the idea is you buy, you hold on to it, and, you know, and you keep buying more. And then it also builds like the book, if you will, for when they need to do like secondary offerings and all these things. But that's their job and your job. But you ain't getting from 100 and what was the 160 million to 5.5 billion. You're not getting this off a marketing job. Yeah, David Fischel would need to, you know, I don't know, probably like, you know, bribe every hedge fund on earth, bribe every mutual fund on earth, bribe every ETF provider on earth to get from 160 million to 5. It ain't happening. You're going to have to do this in a real way. I didn't talk about what they do, but I mean, I did. I mean, I told you, like, they essentially, Stereotaxis makes, I mean, let me get this up. I'll show you. what they do. I mean, you can see here. So this gives you a little bit of an idea of what Stereotaxis does. They don't really show the robots here. Let's see. Show the robots, folks. There we go. There's the robots. So that's. So you can see the electrophysiologist sits at our terminal. They're not sitting there on the bedside. So the robot, yeah, you know, those white things are magnets, and they move like the catheter through the body, right? So that's what they do. That's what they do. Now it turns out that there was actually, in hindsight, very good reason why it didn't work the first time around. And that's because, like, you know, while that technology was kind of decent for its time, there was a lot of stuff that you had to do to get it in. And sometimes you don't understand that something can't work as an innovation until the new thing comes out. So on August 12th, and they just reported their earnings on August 12th, they issued this press release that really, you know, made me think like, okay, the $5.5 billion has definitely made the management, the employees, and everyone be like, we got to get this thing to where people not just like want it, but they need it. And for that, we got to like completely make the thing so valuable, so easy to use, so irresistible, if you will. Because clearly, if you read that second paragraph, I'm going to make this a little bit bigger. The second paragraph is really where you can see the value add. So I'll just read some of this. Genesis X builds upon the established benefits and performance of robotic magnetic navigation systems while reducing the complexities and barriers to hospital adoption of the technology. Preparing an operating room to accommodate a robotic magnetic navigation system has typically, in other words, the old system typically required significant structural modification, including the installation of thousands of pounds of magnetic shielding in the walls. Wow. Yeah, I can see why this didn't sell. Yeah, I mean, how many hospitals are going to sign up for thousands of pounds of magnetic shielding in the wall? Well, it's a credit that they got. Like, I think they've got like 100 hospitals around the world. So I mean, it's a credit that they were able to do it. So there's extraordinary value that, like, even with that, like, people willing to like do this. Then you had to have a reinforcement of the floor, high electrical power, and extensive cabling through conduits between the operating room and the dedicated cabinet room. This entailed months of planning and coordination between site planners, architects, and contractors. Now, the new system, which is Genesis X, utilizes much smaller magnets and incorporates magnetic shielding into its own structure in place of the shielding otherwise installed in the walls of the operating room, requires no structural anchoring through the floor, and operates using a standard 120 230 volt power outlet. And a single fiber is routed from each robot to the system cabinet, which is 80% smaller than the cabinet of Genesis, which is the old system, and can fit under the operating room table. Genesis X is smaller and lighter than any previous generation system and maintains the speed, responsiveness, and efficient flow of Genesis. And there you go. That's the picture of the robot. And that's how it slides underneath the table versus what must have been just this enormous, thing. I mean, I've seen this thing once, if I remember correctly. Yeah, this sounds way, 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 way easier to install, way easier to use, and way more saleable. I mean, I think a lot of hospitals that, if you were a salesperson for a Stereotaxis, are like, hey, thousands of pounds of of metal into your walls, reinforce the floor, separate room, that's got to be shielded. Oh yeah, we need like high power cables. Nah. Hey, oh, you got a room there? Yeah, we can just slide it in here. You just do it all here. Yeah, that's a big deal. I didn't talk about, some of the other things, which is that there's enormous benefits as well, to both patients and doctors. I didn't talk about the fact that it's been established that, because the folks that use that do these procedures, because they're exposed to X-rays, etc., they have higher rates of cancer because they wear this very heavy iron vest. I mean, they have back trouble. So, I mean, there's definitely a price that's paid. So, I mean, there's huge benefits for both doctors and for patients. The patients' outcomes are much safer, much faster because of the robots. So everything, in other words, is now aligned, right? Everything is now aligned. We've got a management that, yeah, there's, they lit a fire under these guys. I mean, look at the improvement. I mean, why couldn't they have done this 10 years ago? I don't really know. I mean, maybe you needed to dangle, a carrot of $5.5 billion, earn 10% of the company in front of them to be like, okay, what do we need to do to get there? Sometimes, having like an enormous goal, right, is what makes you focus and pushes you to really do it. And everything else was there. I mean, the basic science, the basic value of the platform was there. In other words, benefit to the doctors, benefit to the patients, but still it wasn't in a package that really could sell. I mean, this is a company that has struggled to sell systems pretty much, after the initial number of very motivated hospitals that wanted to do this, they couldn't really sell these. I mean, but this system, yeah, we're going to go from selling like 2 or 3 a year, 5 a year, to probably like 50 a year, maybe 100 a year. Maybe we'll do 200-300 a year, right? And that's not necessarily the way they make all their money either. Right? I mean, because there's disposables. There's like this catheter that you have to use, right? That, especially adapted for these magnets. And those are disposable. You can't use them more than once. So, it's this business model that's called the razor blade model. In other words, you buy the razor and then you got to buy the razor blade. And the razor blade can only be used so many times. Then, then you got to throw out the razor blade and you got to buy the new razor blade. I mean, I'm sure you're familiar with it. The old Hewlett Packard, you buy the printer and you got to buy the printer cartridges, right? And the printer cartridges, the margins are like 80%. So that's the basic model, right? Of this. So you ask me, management super incented. Incentives drive what, maybe, I mean, it's not like they came up with all this like last year. I mean, obviously they've been working on all this, but I've got to believe that like dangling that $5.5 billion carrot definitely had an effect on Mr. Fischel, on the employees, on everybody there. But like, yeah, well, like if there was like some detail, like, hey, no, this is no big deal. They're like, no, it needs to like fit underneath here. No, we can't have like one high power cable. You need to make everything work so that when you go and present this piece of equipment to every hospital administrator, there's no objections. Nobody's got anything. Yeah, I mean, obviously it's an expensive piece of equipment, but there's lots of expensive pieces of equipment. It obviously makes sense. You can, increase the number of procedures. In other words, it's win, 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 win for them, win for you, win for the doctors, win for the patients. So let's look at Stereotaxis as a stock. I mean, okay, this is, I just want to put up a very long-term chart. Oops, that's not it. This is like since the very beginning. Yeah, I mean, talking about, let me make this bigger so you guys can see it. You can see, like, I mean, that old high is like pre-global financial crisis, and that's really not even the high. I mean, this thing has reverse split probably like 3 times, and that's why the high is what it is. In other words, this has just been a house of pain, a house of pain for its entire existence. In essence, I mean, like many technology companies, there's the basic kernel of an idea is there, and there's a benefit there, but it needs more work. And Wall Street's very good at being like, oh, you've got like, the first 100 sales, like, and you're showing this level of sales. This is a great time to go public, right? So of course it's sold, when business is looking great. And then from there, it needs to iterate. It needs to innovate from there. It needs to like figure out like, well, okay, I've got this small little market and it looks good for now, but the growth is all gone. And for me to really, for the company to grow from here, we've got to have like, where's the next place? Where's the next step? And it's taken them, 15 years, 15-ish years, to sort it all out. I mean, there's been 2 enormous bull markets in the stock market since, but I think it's time. They've got, they've got enough cash to go through this. It's not particularly expensive to do all of this because, I mean, once the system is sold, they're paid. And then they build a system. It's not like they're going to build an inventory of these expensive systems, and they got to spend all that cash, and then they're going to speculate on, somebody buying it. You're going to get an order, then you build it. So, the cost of running this is not huge. And then I want to bring all this up, but they've got this new catheter as well, which of course, like, the catheter technology in the last 15 years has blossomed. I mean, now today you can put computer sensors on there that give you so much more information. They've got this thing called the magic catheter, which is way more useful, provides all kinds of like feedback information that is incredibly valuable, both for the patient, for the person that's doing the procedure. So the value in the platform, in the technology, in the product has jumped, I would say, like 10x is modest. It's 100x. And none of that is reflected in the stock. Why? Well, I mean, it's not reflected in the stock because, well, I mean, we're going through like a innovation growth bear market, a small mid-cap stock bear market. People are all focused on like, these very large tech stocks. And so, there's nobody there right now. But the way to buy something cheap is, you have to look forward, right? You have to look forward. You have to have some base of assumptions around which you build your case for why there's value, why there's this kind of value is scarce. I mean, there's nobody else that has anything like this. There's no other company that I know of. I know there are similar-ish companies, but in terms of like having this kind of actual product ready to go, and there's nobody else out there. So do you want to be in after everything is announced, when it might be at maybe 20, maybe at 30? Because if I'm right, I mean, and this is a 5-year chart of the company. I mean, I find this persuasive. Maybe you don't. I mean, there's no guarantees in life, but if I find this persuasive, let's say some number of you find this persuasive, are there other people on Wall Street? Are they dumb? Are they stupid? I think they might find this persuasive too. If they find it persuasive, what are they going to do? Well, they're going to come to buy. They're going to start to do what? Well, like, well, okay, you're going to go from 5 or 10 systems a year to 50, you're gonna 5x just your system revenue. And obviously, when you have systems revenue, more systems out there, you're gonna have so many more disposable catheters that are also being bought, right? Those are all 80% margin. You can see this flywheel, right, for this company has definite potential to get to 5 billion. Not tomorrow, not by the end of this year, but if you've got enough of a time frame, I don't think it's going to take 50 years either, because once you have 100 systems, new systems sold, I mean, now the catheter revenue starts to, really kick in. And then once a hospital has has it, the neighboring hospital want it. And if it's, I mean, and we've got an aging population, the primary procedure here is atrial fibrillation, which is something that, I think there's like a long wait list because of course we have like medical personal shortage. Bottom line, I think things are aligned. Things are aligned for Stereotaxis, for Mr. Official, to, I think, make his bogey. And hey, if he makes it, we all go along for the ride. We also so get rich, and that's capitalism, folks. It's beautiful, right? It's win for everybody. It's good for patients, good for doctors. I like it. All right. That is the live stream portion of today's. We got a lot of comments here, mostly from one person at the bottom here, but we'll just put them up as we go along and see what happens here. Good afternoon, sir, from Lakeland, Florida. Thank you for attending the live stream. David says Fannie Mae and FMCC, it's just Freddie Mac will be more than likely released from conservatorship no matter who gets elected in November. Yes, can you elaborate? David is clearly a follower of me on X, and I might as well share these. I put up a series of posts on X. It started with that. Whoever is elected, Fannie Mae and Freddie Mac are going to be set free. And I said, Fannie Mae and Freddie Mac hold the keys to unlocking $1 trillion in home equity. I don't have the articles that I was taking these facts from, but it comes from a CoreLogic. CoreLogic is like probably the best known like consulting firm in real estate. Says that there's an average of $305,000 per owner of home equity in the home, and I think having a program where you can tap this is going to be very politically popular. Because if you can just simply take your home equity and get a 4 or 5% loan on it, and there's enough equity there where the basic mortgage can still be held, I think people are going to do this. So that's my viewpoint on Fannie Mae and Freddie Mac, which is that Freddie Mac asked its regulator, I think in May, if they could trial a program like this. It was approved. And my view is this, which is that you cannot scale up essentially a whole new second business for these companies under conservatorship. You can do a trial and you can do maybe like a prototype of it, but I don't think you can do it on a wholesale basis because you're going to need to build the company out. You probably need to hire more people, build new systems. You're going to have to like spend more money than what, is like sort of like might be tolerable under, conservatorship. And being that, politicians want to get reelected and into a slowing economy come the second half of this year, early next year, people be like, yeah, if you can tap home equity, we can get, that's a source of spending and consumer growth. And then that will be politically popular. And if you want to see it in this way, I mean, like, why were Fannie Mae and Freddie Mac sort of like taken under conservatorship? I've seen lots of analysis that said that essentially, I mean, there was no real financial need to do it, but the bigger reason to do it was political and emotional. I mean, the markets were incredibly fearful at the time. There was a panic that was on, and it was seen as a way to control really both markets, emotions, and sort of like the the politics of like bailing out Fannie Mae and Freddie Mac. I guess nobody wanted to deal with that, and that's why they were taken in. So, in other words, it was done ultimately for the expediency of politics. So, why wouldn't we see that in reverse? I mean, that's the essence, really, of what I'm saying. Edward STX says prospects are up. Well, I mean, down and up are all about like our emotions, right? I mean, the stock price is what like dictates our emotions rather than facts or evidence. And I think like one of the big things that, as I've been in markets longer and longer, is like, I mean, the way to wealth is clearly to invert our psychology, because I mean, I mean, like all of our systems are built to be like stop losses. I mean, in other words, they're always to, and it's generally in some ways sell at low prices and to buy at high ones. So yeah, to make big wealth, you have to invert it in some way. And sometimes it may be a big system crash. In other words, everything crashes. Sometimes it's where one stock crashes, or a sector, or parts. Right now, we're clearly in a growth innovation bear market. Assets are cheap. Stereotaxis is one of them. Because I can tell you, if we were in a bull market right now, yeah, that press release talking about what their systems are going to be in the future, this thing's rocketing higher. This thing's rocketing higher. In other words, the moods matter. The moods matter. Robert from Plant City, Florida, welcome and appreciate you joining our live stream. Tom from Sun Prairie, Wisconsin. I'm going to look up Sun Prairie, Wisconsin. I wonder where that is. Is that in Door County by any chance? I've heard beautiful things about Door County. And wow, we've got an international audience here today. Mahfouz Hussein from Kurdistan. Welcome, sir. Appreciate you joining the live stream. David has a question on Ginkgo Bioworks DNA. This is a Kathy Wood company, and I think Ian King, who was my ex-colleague from Banyan Hill, he recommended. I think like Ian Dyer did recommend this briefly, but I've not seen like how they can really size up their business, at least not yet. I think every technology like Stereotaxis has a future. The question is, does the future line up with like the commercial development? Because you can always get a stock pump from enthusiasm, from hype, and from like just market sentiment. But as you will see with Stereotaxis, I mean, if you don't have a business that is real, that's not sustainable underneath it, it never lasts. And so we're not there yet with Bioworks. Maybe we'll get there, maybe in the next 6 months or 12 months. But we're not there yet, in my judgment, in my opinion. But I mean, they have a technology and it's clearly quite good. But, you can see like, a company that comes public, it's in one shape, the technology, and then like, to make it into something that is scaled up, that can sell and can grow for years, it may take like a number of adjustments, which sometimes can take a long time. Ed says magic catheter must be approved. Yeah, that's true, but the approval process for devices is not like it's not like biotech drugs. The failure rate in biotech drugs would make you sit up and pay attention. But the magic catheter, this mostly procedural, and they're well on their way. I think in Europe it'll be by the second half of this year. In the US, early next year. So this will happen. Wow, we have some informed live stream members here. Edward, you are keeping track. Yes, they just recently bought a company called APT. And I found out a detail about this, which is that the management of APT took all stock. I wonder why. They probably went and saw what David Fischel, the CEO, is being incented by. Like, we'll go with you. You're betting on 5.5 billion. We're with you. We're with you. So like, yeah, they just bought a company, I think for, I can't remember. It was not for billions of dollars. It's like for, I think it's 10 million or something like that. And they took stock. Right. I mean, that's a vote of confidence, because when a deal gets done, there's a lot of due diligence that happens on both sides, because the company that's selling, has to decide like, well, do we want cash? Do we want stock? Whatever it is. So they have like, they get to see everything that's there. And clearly they are voting and like, hey, we will take this. Under followed company. Yes, very much so. Yeah, that's often the case. I mean, remember, there's like 4,000 companies out there, and we're down to what, like, maybe 8 or 10 investment banks. And investment banks, I mean, they're in the business of merchandising stock, right? They're not in the business of unearthing value, right? I mean, so what is their incentive when they cover a company? Well, their incentive is like, well, can we is this a potential client for investment banking business to sell stock, to sell bonds, maybe run a buyback program? If it's not that, then maybe it's to like, be like, hey, well, can we get clients, brokerage clients, by covering something that they're interested in? So there's a lot of stocks that simply don't meet any of those criteria. And if you are self-funding, and Stereotaxis has done some small deals. I mean, they have, but they've done it in a way where they've not like done big underwriting deals. They've had a at the market sort of like secondary offering that's ongoing. That's not going to generate a lot of fees. So there's no real incentive for anybody to come and cover this until they get big enough that the wider market is like, well, what is the Stereotaxis company? Now they're like, okay, there's some benefit to them. So that's when the analysts will come on. This is, what Edward says is what I'm saying. Edward is like BlackRock number 2. Yeah, but this is a trope, folks. I mean, when you go on X, like BlackRock is the number one holder. Listen, this is an index. It is an index fund holding. They are not like owners of Stereotaxis by like stock selection process. It's just something, it's part of like some index, and that makes them the number 2 holder. And a lot of these smaller companies, people will cite that, BlackRock is the number 1 owner, but it's often just an index holding, and it doesn't really necessarily mean anything. It took months to install. Yeah, I mean, it must take a long time to put all those metal plates into the wall. Wow. Okay. Edward is very, very well informed, folks. Yeah. Yeah. I mean, all their old systems. Well, it turns out there's a good reason why they didn't sell. In good sell. Abbott Labs partner. That's correct. They've signed a deal. I think it was late last year, and the stock popped for a bit. In other words, I think it works with Abbott's system. And then there were rumors that Abbott is going to buy them out. I don't think so, because if you go and look at the holdings, I think over 30 or 40% of the company is owned by 1 or 2 hedge funds that clearly understand the value of what they have. They're not going to sell it for whatever, 40% more, 50% more, even though I'm sure lots of retail holders would perfectly be okay with it. They clearly are looking for something much, much, much bigger. Going through more of the comments here. Hi, Paul. Do you have any more positions on your radar to sell in the future? Well, I have taken the view in ATG portfolios that we're at some sort of like peak in terms of computer technology being like the thing that everyone focuses on. We have gotten inured to the idea that like technology, meaning computer technology, is going to be the leader of markets for the future. And from experience, generally, when you have that view widely espoused and everybody's chasing that almost exclusively, and you have evidence of that by things trading at 40 times earnings, etc., generally the market goes in some other direction. And so we have like lightened up all through 2023 and 2024 on pretty much all the, like, like cloud computing companies and everything. And our bets are very much now on what? Well, biotechnology, genetics, new energy, crypto, fintech, 3D printing. Where else? These are like the primary places. I mean, and generally like consumer companies that are growth oriented, where they're like Shake Shack and things like that. That's where our bets are. In other words, we are trying to go to where we think the puck is going to be. The puck right now, and has been for a long time, has been on computer technology, which people just call technology. The truth is that technology is a word that, if you go back, I mean, even in the 1990s, even early 2000s, had a much wider definition, because there's been no real market movement. There's been no real huge sort of like thing like the iPhone to focus on. Technology now just refers to computer technology. But I believe that, we have enough, certainly we have enough capability in biotech and genetics, and even in medical devices, to see enormous jumps in their capability, which is not priced into assets and not priced into stock prices. And it's always there that the big returns come from. So we don't have anything that's very big that we plan to. There's no like sector-based cells that we want out. We've sold out of chips. We've sold out of cloud computing. We're just generally lighter on all of those sectors, because while it may not be the absolute top, I think, like in hindsight, and we are thinking long term, 3, 5, 7, 10 years, these prices are high relative to the opportunity set. And there's all these other places where the prices are low relative to the opportunity set, and we want to be where, the growth is going to be. What do I think about you, which is Unity, and Mobileye? Well, both brutal in terms of stock price, clearly. But I continue to hold out for the promise of whatever the metaverse eventually becomes. Maybe it is part of some VR world. Maybe it is somehow fused with, what Neuralink and is working on, and Unity, from my understanding, is like the technology platform that you have to have if you want to implement any of that. And so, if that's right, then this is a part of computer technology, which like nobody's really like, I mean, AI, everybody's super excited about. Metaverse, they're like, Paul, Meta tried it and they failed and they cut it all down. I don't know. I think there's an online world that is immersive, has some appeal, and I base that partly on on young people. I talk to my son and his friends, etc. They're interested. They would like that. They have grown up in a world where these things are they don't have the same weight as the physical world, but they are things that are very much something that they sort of like intuitively understand and want to participate in. Exact Sciences, I mean, this is part of the genetics bet that we've made. Exact Sciences has this blood biopsy test, which is for all kinds of cancers, along with Grail. These are the only two companies that have it. I mean, a test that is universal for all kinds of cancers. I think that could be a big thing, and that's what we're holding out for. This is my mom. Hey, mom. She's watching all the way from India, so I want to say a shout out to my mom. And Ed, SDXX reminds me of EMC in 1990. No one took it seriously at $2. I mean, EMC was a Wasn't EMC a spin-off from? I'm forgetting where EMC was spun out from. I was going to say Micron, but I know that's not right. Miss Puppy Pop, love the name. Platinum member here. Stereotaxis sounds very intriguing. Any thoughts on Joby and Archer? I am following all of these: Lilium, Archer, Joby Aviation. The key is again this, right? The stock price, right, is following like little developments like, hey, we just got this license certification. Hey, we have this partnership with whatever this airline. But as you can see from what, the chart that I showed with Stereotaxis, idea, and then execution can live in two different worlds. And like the idea can get pumped up and we can get some stock price performance, but sustainable stock price performance comes from building a business. It's not from the idea of the technology. And thus far, eVTOL, no one has yet built a business. There's proposals to be like, hey, I think like Joby has said that I think like they're planning a base in California or Orlando. I can remember Archer, the same thing. Well, they got to, spend the money to build the base. It's going to cost a lot of money. They got to then like ramp up and spend a lot of money to build all the machines. They got to build a business model. And that's all got to be funded. So when I watch the price pumps on this, I'm like, okay, like, yeah, I mean, I think we own Joby Aviation in the GBC 100, which is our sort of growth and innovation index, which we track in the Substack. And I track it, but the question always is like, yeah, do you want to invest here, which is then very sort of like iffy, right? Because it's based really on like these news events, right? They're not actually building business value. In other words, there's no real sales or sales growth or earnings growth. And also importantly, they need money, right? So the reason why the stock price shows this is that the investment banks are aware. And I told you, like, they'll cover Joby, they'll cover Archer Aviation. Why? Well, they have capital needs. So that's stock underwriting. That might be bond underwriting or whatever it is, like, so that's one of the reasons why they'll shine a light on those stocks, because it serves their purpose. But the business value, that's hard work. That's hard work to build. And so I'm tracking them. The stock prices, I think, have been going up recently, which is great. And it represents technological milestones. But unless they also represent business milestones, it's at some point what's going to happen is this, which is that you have to have big time investors, regular investors who focus on cash flows, focus on sales, focus on earnings come, and they are not going to touch an Archer or a Joby Aviation unless they have like it's every once in a while where like one of those investors like really believes in a technology, and they're like, okay, I'm going to stand by this company, stand by this technology, kind of like Tesla. Like Tesla was whatever, a $40 billion company when they were making 5,000 cars. Why? Well, because, there were big time investors like Ron Barone and others. They were like, we believe in the vision of Elon Musk. We believe in what he's doing. We think he can make it happen. But those are few and far between. And so I'm looking, I mean, they're very sexy technologies. I'm very interested. There's definitely, a place for it. I mean, I think I would love to ride an eVTOL rather than wait in traffic for some of these like, regional trips that I make. I mean, to go to DC, I drove in my Tesla self-driving. I mean, this is a trip that should take 3.5 to 4 hours. The last 25 to 30 miles to DC takes like between 60 to 90 minutes if you drive. That's brutal. I mean, to be in an eVTOL, like even if I drove halfway and took an eVTOL the last half, yeah, sign me up. But we got to get there. We got to get there. So that's a long answer to being like, I'm interested in the technology. They have a lot of promise. We need to see the technology mature out, get licensed, be certified, and someone build a business model where they offer a value proposition to a customer. STXX has some impressive members. Yes, yeah, they got one from Intuitive Surgical, I think sometime last year. Joe Kiani owns 6 million shares. Okay, well, I don't. Yeah, I think like that's one of the guys that is part of like I think the Daphne group, or maybe he's different, but I do know this. Uh, and that's greetings to you, Mom. A lot of questions today. Happy to answer them. Nell says, I'm holding on to Teladoc. What's your thoughts? I mean, I very famously did a bottom video on Teladoc. Was it 2 weeks ago? And I have egg on my face, right? Because I'm like, calling bottoms is brutal. You feel stupid and dumb. But the thing is that here's really why we own Teladoc in the silver tier ATG portfolio. Why are we holding on despite like showing brutal losses? Number one, this used to be a huge growth company. Like, I mean, we owned it in the True Momentum portfolio for 2 or 3 years, and we made a lot of money on it, right? Then 2020 and COVID came, and their growth went like steroidal, right? Then they took their very expensive stock price and they bought this company called Livongo for like $18 billion. And the idea was to integrate artificial intelligence and machine language analysis and put it together with telemedicine. They clearly paid too much for Livongo when growth rates were very high. And then since then, they've experienced very little growth. They haven't like incredibly contracted either. It's not like they've gone like negative 30%. It's just that the growth has been 3%, negative 2%. There's nothing there. And meanwhile, the sentiment for growth companies has just been crap. In other words, people don't want to own them. And the price to sales ratio, which used to be like 10 or 12 or something like that, is now like 0.3. So what needs to happen for Teladoc to like resurrect itself? Well, they need to bring back some amount of growth by extending themselves into some new markets. The sentiment for growth stocks in general needs to improve. But the underlying premise of the stock is this, which is that you can't have like 20 telemedicine networks. And I call it a network for a reason, which is that the doctors can't belong to like 16 different networks, right? They can only be like, on one screen at a time, right? So once you get enough of the doctors, well, the patients have no choice because they need the doctors, right? And in truth, the doctors have no choice because they need the patients. So this network effect tends to be a very powerful thing in stock market performance long term. It's true in Amazon. The sellers are all on Amazon. Why? Because all the buyers are there. It was true with eBay. So this network effect of doctors and patients, in my opinion, has value. Second, we're talking about a highly regulated world. It takes a lot of capital to build this network. Doctors are not just going to join like, any fly by night, like, new telemedicine operation. So I noticed that Amazon, for example, has launched their telemedicine operations and they make it very easy. I haven't tried it myself. Maybe some of you have tried it, but there's clearly a need from that perspective that Amazon sees. I mean, like, why are they going to mess around with telemedicine? This is a $1 trillion company, right? There has to be like enough of it's clearly a large market. And there's clearly like a need that they have researched and understood. They're willing to expend their time, effort, and resources. The market leader is still Teladoc. So I don't know, maybe I'm wrong. Maybe they'll sink into the ocean and be worth zero, but I'm not going to sell it at 0.3 times sales. Yeah, I mean, I own it myself and I'm not going to sell it at 0.3 times sales. Edward is very well informed. EMC messages come 5 cents to 120. Dell bought them. Okay. Yeah. Thank you, Edward. Yeah, I mean, I get what the technology is. I mean, it will be a drone that moves people 100 miles with no pilot. Yeah, I mean, I totally understand that, but you have to build a business, just like, Stereotaxis built this robot, and it could move catheters, but it's taken them 15 years to find a business model, to sort of mature their technology. Merch. All right. Well, we've had a lot of questions from a lot of you. I really appreciate all of you showing up for this live stream. Still, I think the closing sort of stages of the bear market in innovation, growth, small, mid, still there. It's only a bull market, when we get to new highs, right? So, I mean, I think we're beginning on this transition where like the focus has been 100% on very large companies and in particular big tech. And as I think the second half of 2024 unfolds, and I mean, what are you going to do? Pay 100 times earnings for Apple? Are you going to pay like 200 times? I mean, there's a limit to where this can go. I think there's a lot of money that's going to pour out of these big stocks. And then they're going to want to find homes where they can, get results. And yeah, I mean, all of these companies trade for nothing. They've just been so destroyed. So, all right. I'll end it here. Thank you all for attending this live stream. See you next week. Check into, I always forget to plug atgdigital.media. That's the actual website, atgdigital.media. That gets you there. And yeah, for subscriptions, we begin at $9.99 per month. All right. Thank you, everyone, for joining this live stream. This is Paul saying bye.